Joins us again for the second half of the show. Thanks again for having us here, Glenn. We've talked about the BRICS. We've talked about specifically Brazil and India. What's going on in South Africa? Let's talk a little bit about the investment case for South Africa Inc. What's the perception investors have of South Africa at this point? You meet with these people, these guys all the time. Has the perception of South Africa dramatically changed in the last 6 months to a year?
So I think there's two broad contingents or constituencies we need to talk about. The first are the local guys. The local managers almost en masse see South Africa as expensive and are taking money overseas and have done. The vast majority of managers will sit at or around the maximum that they're allowed to, which is about a 25% allocation. They can also take a further 5% to Africa. And most of our managers are sitting at or around the maximum type of exposure. So South Africa has done brilliantly. It's had an unbelievable 10 years in dollars or rand terms, whichever way you want to look at it, has dramatically outperformed not only Western developed markets we've done badly, but even emerging markets. It's outperformed Brazil and India and emerging markets in general. So South Africa has done unbelievably well. And hence, when I think our managers look at global portfolios, which is increasingly what we've given them, the ability to look across the entire globe, not just separate South Africa and global portfolios, they're taking money overseas. They see much better value there and obviously much greater opportunity. There's thousands of listed companies there. There's 40 big listed companies in South Africa. The international investors, I think it's fascinating. We look at last year what happened in terms of capital flows. Money actually left our country in terms of equities. It was tiny, but it was broadly zero, but it wasn't positive. But we had about 90 billion rand come into the bond market. So it's been South Africa's inclusion in the World Government Bond Index was a very big driver. Our bonds have done well, etc. But from an equity perspective, I think the managers were not net buyers last year. And I think the recent events in terms of politics, the credit downgrade, net for net has probably led to a slightly more cautious tone on the country. I think the flows we have seen into the country have been directly this theme that we see everywhere and everyone we speak to. We saw it very strongly in Brazil. I went to a retail presentation. I got there a minute late. I couldn't get a seat because the 300-room auditorium was full. The emerging market consumer theme is a very powerful theme, right. and global managers are playing that. And I think South Africa has been a huge beneficiary, and our South African retail shares have benefited. I mean, in many cases, more than 50% of the shareholding of some of our major retailers are now held by the global guys. Our local guys have been selling. That's been the play.
And it's been interesting seeing that trade-off between how the foreigners have viewed the retailers' shares and how the local investment managers have done that. It's just something I wanted to touch on. You indicated that you're increasingly giving your investment managers global mandates. Is that a shift in the thinking around the way you allocate capital?
It is. For many, many years, most of the time that I've been in this business, we had separate portfolios. And when you were allowed to take 5% of your money overseas, which is where exchange control first relaxed and allowed one to go many years ago, it then moved to 10 and 15. But 25% plus another 5 to Africa, this is now very material. So the call, for example, on the rand is very material. And we want to give the managers who we think are far better positioned than the clients or the consultants or even ourselves in terms of making that call. Where do you want to, if the rand is sitting at 20 to the dollar, maybe you want to have more money back in South Africa. And maybe at 5 to the dollar you want to, so we're giving them a lot of flexibility to move the money between currencies that they want, regions that they want, asset classes. And I really do think that is the way to play an increasingly global world, but also a very volatile world. And even it's not volatility day by day, because I know the VIX and other measures of volatility have fallen quite dramatically. But over 6 months, you can now have markets up 20 and then down 20. The managers now have the flexibility to do something about it.
In terms of those global mandates, what's the sort of split between local and offshore investment managers? Is it? I imagine in the beginning, when you started taking the money offshore, it was very much oriented to offshore investment managers who had a specialty investing in emerging markets or in global portfolios. But we've seen, as the rules have changed, a lot of local managers turning their attention to running global portfolios. I know the likes of Coronation and even some of the small investment managers doing a very good job of running money offshore. How do you sort of play the split between the two there?
So, I mean, we've run global portfolios for about the full 15 years that we've been at the company, and it's gone full circle. Initially, we gave the money to our local managers to take overseas. Why? Because we knew them and because it was 5%, it wasn't a big weighting. And as that number got bigger and bigger, we thought that we could do a better job probably giving it to global managers. Now that broad process continues. We do have, in a global-only portfolio, local or global managers have to compete head for that space. The money that I'm talking about is often money that's benchmarked against the local inflation or the what we call the Alexander Forbes local large manager watch, etc. It's got a local benchmark. Against that, we want managers who are thinking about South African inflation or South African. So the money that I'm giving to these South African managers is South African managers with a global tilt. If it's global-only mandates, we typically would still give those to global managers. But I must point out both local and global managers have found 2012 unbelievably difficult. The proportion of managers outperforming a benchmark is minute. In some funds, less than 10% of global managers outperforming. I think locally, maybe a third are outperforming. So last year was a very tough year for active managers. So notwithstanding the volatility, it changed directions all the time. So managers that did well for the first half of the year, then gave it back in the second half of the year, and were still behind benchmark.
This brings us to a topic that I guess continues to continue around the active versus passive debate and how you as a multi-manager incorporate them. ETFs are a meaningful size of the world investment pot, but they're nowhere near the size of challenging the actively managed pot, for want of a better word. How do you think about using, do you use passive strategies and you know, when are the right times, or how do you think about using a passive strategy in a portfolio?
So I think it's a hell of a good question, and you're quite right. So germane in a world like 2012 when you have active managers underperform. And what we've said for the length of time that I've been in this business is we embrace both. We certainly have a preference for active management because we believe they can add value and we can find great active managers. But in many of our portfolios over time, our global bonds, global equities, local portfolios, we have incorporated either passive or semi-passive components. I do need to point out that even in passive, there's some active calls to be made. I mean, you made the point quite correctly. There are many, many listed ETFs. The choice as to which one you choose is very relevant. In South Africa, if you take the Swix benchmark last year, or the Aussie benchmark, there was almost a 3% gap just between that. And your other there's capped benchmarks, and you know, there are a lot. Internationally, there are hundreds, if not thousands, of listed ETFs. So I think we think there is definitely a place for it. We think you need to consider it. There are many active decisions in choosing passive, which you need to think about, and I think those are very relevant. And then also you need to be quite cautious about the structure in which it's held. I'll give you an example. I mean, we are fairly big holders of something like New Gold debentures. That is backed by the gold bullion. They fly out aeroplanes, I don't know, 2 or 3 times a week to London. They actually put the gold, so it's actually backed. Where you have, for example, a backing by a bank or a backing by a piece of paper, I think you need to be a little bit more cautious about whether or not you're really getting the underlying exposure you think you're getting. So they actually take a lot of work. You've got to do a due diligence operation, in other words, on those. And those are some of the concerns that I point out. But passive per se definitely has a place. And I think in 1 out of every 3 years, like last year, passive is going to outperform.
Very interesting, and I think the market conditions dictate a lot of, about how many active managers are able to beat an index, as you pointed out. Just to touch on, and without stealing any proprietary information from Investment Solutions, you interview and do analysis on many different types of investment managers. Are there any common attributes that you find among them that say to you, this is going to be a person, he or she, that's going to be an incredible investment manager and be able to beat the benchmarks regularly?
So the answer is obviously yes. We believe that we can pick good active managers. We've designed systems to do that over time. They're relatively simple scoring systems that look at the factors that we believe drive performance of managers. You used a very important word there. Do we believe active managers can outperform? Yes. The consistent word is it's not year in, year out. The best, the Buffetts of the world, and there are hundreds of examples of managers who have outperformed very substantially over 10, 20, 30 years, but would underperform for 3 comfortably, and quite dramatically so. So I think one needs to be cautious, and that's where I think the multi-manager portfolio can help a lot. We can pick managers who do well in this environment, others who do well in the opposite environment, and if you can combine them together, you're never going to be best ever, but you're going to have a much smoother ride, and over time we do rise to the top, and we have evidence of doing that. So what are the type of attributes? I must tell you something, it's not about genius. Increasing is not about something really, really smart. I think common sense and pragmatism plays a very big role. One of the questions we ask when we see a manager, and it comes down to almost the bottom line, is would you give them your own personal money? Has this person got some insight and approach and thinking about the world that you think can lead to outperformance? And typically it's very rarely an individual, very rare that we ever pick an individual. Right. We might pick an individual portfolio manager, but backed by a process and systems and backing whatever. A single star portfolio manager, sure, very rare that they give you consistent returns. And the other thing, in order to get good returns, you have to put bets in place. You have to have a bias, you have to put a bet. The bigger the bet, the bigger the payoff, positive or negative.
Just in terms of just to finish off, where your investment solutions has been quite actively involved in adopting and implementing, and I think encouraging investment managers to adopt sustainable and responsible investing practices. Why is this so important? And are we behind the curve from a global perspective on this, or are we keeping pace with what's driving this change throughout investment markets in overseas specifically?
And I'm delighted you asked the question because it's very close to my heart and our heart. It's something that over the last year in particular, I mean, before we thought about it a little bit, but we've really spent a lot of time and energy, and we're going to be driving this as one of our key themes. And it's not just a theme, it's something that's embedded directly in our process, our philosophy, our discussion with managers. So we, in the course of the last year, have redesigned our scorecards with managers, our questionnaires to managers to actually focus on these things, because we think we live in a finite earth. I mean, I hope most people concede that. And there are a lot of people, you've got 7 billion people on the planet, and we're consuming the environment at a very rapid rate. And we can see what happens in a NASDAQ bubble when it goes sour and it's not sustainable because there's a business model that doesn't make sense. You lose 75% of your value. That's how much the NASDAQ fall. 50% of this company perished. I don't particularly want to put our widow and pension money into stuff that's going to vanish and disappear, etc. We saw the housing bubble where 42% of the largest asset class in the world, I mean, this banked the global financial system, certainly the US banking system, but it had implications globally, collapse and vanish and disappear over the space of 5 years. So we want our managers to be taking that slightly longer term view. We want them to think about the externalities, the impact on the environment, the impact on our portfolios, and we think there are two major reasons for that. One, definitely reduce risk. I think the studies we have seen kind of prove that unequivocally. But secondly, there's a possibility of enhancing return as well. Right. So I think it goes to the heart of what it is that we've promised our clients. Above average returns at below average risk, and it plays to both of those. And I happen to think it's an important thing for the world anyway. We need to start focusing on these areas a lot more. We've been quite cautious in our approach. We've been quite measured. So for example, we did a survey in April of last year to 46 managers locally and globally. And we're delighted at the outcome, and it's going to become an annual survey. We'll be doing another one at the middle of this year again to see if managers are progressing and where the thinking is going to. But South African managers can hold their heads up pretty high. They were not in any way deficient or behind what we see in the rest of the world, with one exception. Local equity market with 40 big tradable stocks doesn't give you much opportunity. We're very cautious about not doing screening. Imagine you took those 40 shares and said you can't invest in 36 of them. It's not going to be a great portfolio. So I think recognizing the limitations of that for South Africa, there's a lot of great opportunities in the unlisted space, etc., but it's more complicated because it's unlisted. But globally, I think there's a wonderful opportunity to do and enhance both risk and return. So we think it's fundamental. We're very excited. I present often on this. I'm quite passionate about the topic.
Yeah, I can see that. Well, thanks very much for your time, Glenn.